It's really an honor to be here. So I've been an ambassador for financial services for GBBC for, 4 years or so now. And I am thrilled to be here at Davos and also to moderate this panel. So my name is Lynn Marler, and I'm a co-founder of Women in Digital Assets. And as I said, I've been a GBBC ambassador for quite some time. And we have a great panel. I don't know if they're still here. Can we find you? Rob Massey is here. And I'm going to let each of them introduce themselves, just a little blurb. So Rob Massey from Deloitte, Tanvay Singh from UBS. Tanvay is here. Good. I think everybody's showing up, which is terrific. And Georg Schneider. Georg, there you go. Great. So I'm going to take a minute and have each of you introduce yourselves. If you would. Do you want to start, Georg? We'll start with you.
Yeah, sure. Hi, everybody. Georg Schneider. I'm heading financial engineering at Digital Asset. I've been with the firm and in the industry for about 6 years now. Left at the time Credit Suisse, where I was working in equity derivatives and structured products. I feel like it was right at the right time, and never looked back since. And really wanted to go into this industry because the problems that I saw, in that firm just couldn't be solved with the technologies in existence at that time. Nice to be here.
Hi, my name is Tanvi. Very familiar crowd. I've been coming into GBBC for the last 5 years, this time a little more formally as the new GBBC board member. I've been working for the last 10 years in the Swiss banking, so I do share my experience of working at Credit Suisse, now at UBS, but not because Credit Suisse and UBS have joined together. I joined UBS a little early, before the integration did happen. And in my roles, I have been leading the group efforts for UBS for AI and data. I think David talked about that quite a bit around why it is important to have the right data. So we implemented the project for data mesh at UBS to get us ready to ride the Gen AI wave. Alongside that, my new role comprises of leading tokenization platform for UBS. As we do have lots and lots of very important clients, we feel that we are in the right place to create the marketplace for very many tokenized assets being developed by very many boutique firms that we can then present to our client base. The topic that we're going to talk about today is very near and dear as we continuously keep talking about different chains and the pros and cons, so look forward to adding a lot to the dialogue. Thank you, Melinda.
Thank you. And Rob.
Hey everybody, Rob Massey. I am a partner with Deloitte, and I also founded our blockchain practice back in 2012. Nice to be here. GBBC, well done again with the sunlight. This is awesome. So I am all crypto all the time. It did start with tax in 2012. I'm a tax partner, but I spend my time in lots of different competencies. And importantly, we serve every segment of the ecosystem. It's a complicated ecosystem. The transaction flows, the asset types are unique, and they are different. So it is only when you serve deeply and understand the technology and the business flows and the legalese around each concept, do you understand how it all holds together? Then do you have the framework to think about what happens when we converge these technologies? So love this topic, and thank you for having us, Lynn.
Oh, thank you. I am just honored to be here. So from issuance to asset mobility, can it all be done on chain? I think, Georg, I'm going to start with you. What do companies and organizations have to rely on when they start thinking about on-chain versus off-chain, private permission, et cetera? So what are some of the things that, to set the stage for us?
Yeah, sure. So I think in the industry we've been talking about sort of this public-private dichotomy for a long time, and I think it's somewhat outdated. And if you read some of the recent statements from the regulators or from the Basel Committee, it starts to get much more nuanced, and the statements actually go into what are the actual requirements that a given chain needs to have in order to host, tokenized traditional assets and get the same treatment as their traditional counterparts, right? So we're kind of trying to move away from either being classified a public chain, and what does that even mean? There's permissionless environments or a private chain, and really start talking about what are the properties that you need to fulfill. And I think there's sort of two critical points that you need to consider if you're talking about tokenizing what people call real-world assets these days, which is, you want to have connectivity, right? Because that's all what tokenization is about, right? What we've seen in the public chain space with DeFi, this seamless interoperability, applications, protocols, just working together in an entirely new way. You need that connectivity between applications, but you also need a certain level of control over the applications, and that's the regulatory angle, right? A central securities depository cannot rely on some unknown third parties to fulfill its function, right? So you need that control and the connectivity, and that's been sort of a combination that's quite hard to achieve, and that's essentially what we've been working on for 9 years now.
I'll chime in and just add, it's difficult to know where things are going, particularly when you're coming up with these new products. And so having a chain, a community that is known and that you trust and the community can collaborate such that when the product evolves or when the regulatory environment evolves, you have a community that's able to move with the new regulatory frameworks versus trying to convince an unknown community to commit things in its advancement to stay regulatory compliant, right? I think there's a real differentiation there to have that built-in community and have a little bit more control, however we choose to phrase it, right? Private permission, whatever you want. But it's having that tight community with elements of control so you can help guide the future towards staying compliant.
So when we did our prep call, we talked a lot about sort of the role of, what is the beginning role of the company or the organization, and how does that build out really for levels of control, for privacy, connectivity, et cetera. Can we talk a little bit about some of the use cases and applications for this? Like, how does a company, totally go make a decision to be totally a private network, et cetera? What are some of the considerations that need to be thought about?
Perhaps I can start representing a big company.
Yes.
But toiling into the fact that we were just discussing before, a few pointers to add. I think regulatory regime is very important. In the projects that we have done in the big banks, per se, we have spent 80% of our time, energy, and money on regulatory legal clearances with the lawyers, and less than 20% with actual technology. So it's not about Switzerland being regulatory friendly, which it surely is, but it's a very small country. And then when you align to bring in two regulatory regimes together, that's a very hard task. So amongst everything else, I think humans and communities and consultants like yourself can really help us on so many different things. But bringing the regulatory regimes together for us as big banks have been very hard. And that's the reason a lot of the work and a lot of the appetite that our business stakeholders have towards tokenization gets extremely limited. So when it comes to the use cases, people talk about fractionalized arts. We talk about real-world assets. There are multiple different buildings in Switzerland that have been fractionized and sold in the market. But the one that the big banks are focusing on is the structured products for various different reasons. First of all, there is a whole market out there that the products do not touch today, given the sizes which fractionality can bring to the table if we are doing them on the blockchain. Making sure that these digital collaterals can be used, which right now is really hard because our collaterals is just physical assets for today. And third of all, I think it just reduces, if it is all done on a blockchain, it reduces the cost of running the structured products. So it brings in productivity. The challenge, though, is that right now we are running towards, so David talked about the convergence of different technologies. I feel there is a convergence of traditional finance and the new technology in finance coming together. So that convergence has started to look good. But till the time this will happen, we, as big organizations, spends an equal amount of money of managing our infrastructure. So there's no reduction in cost, and the same amount of time building up the new infrastructure that does its pipes and activities on both sides of the chain. So those are the challenges that comes across. Otherwise, there's a whole market out there and a whole appetite of clients and the business stakeholders and the issuers that want to create these tokenized products, just that it's too expensive and the regulatory regime is too hard to get through. Some of the projects we have done have been running for 3 years, just mentioning, the different chains we have been using on different use cases. So mostly when you're trying to operationalize and try to experiment with a class, you try and use a private blockchain because you have the control, you have the privacy, you don't have to worry about security. But once you get open into the market and you want a lot of issuers to come in, then obviously it's much more of an inclination to go towards the public chain. And since last year, we have started to see even the regulators getting very comfortable with a properly scalable public chain to be worked on.
So how do you make that transition between sort of the public and the private?
Use cases to use cases?
Use cases to use cases. Okay, great. Rob,
Or you choose a technology that's sort of right in between, right? Because there is, as I mentioned earlier, the sort of we always have to consider what does it mean when we mean public, right? It means open access, anyone can join, and that's a really important aspect to your point about tapping into the ecosystem of issuers, tapping into the investors, and so on. Now, it doesn't have to mean that the entire chain is entirely permissionless, and you essentially let anyone come into your application, right? So I think that's a critical point when it comes to choosing the technology. And on the other side, you mentioned privacy, in particular when we're talking about sort of institutional investors and yeah, I'm going to say it again, real-world assets. You need to maintain a certain level of privacy, otherwise institutions wouldn't be comfortable, putting their positions out in the open, right? But I think earlier you also hit on a really critical point, which is, what people actually expect to get out of the tokenization, right? And I think what we've seen a lot is examples where people sort of tap their toes into the water and tokenize an asset, but often then it kind of, there's an implied question, so what, right? And you mentioned cost. That's something that I've been able to witness firsthand in the structured product space, right? You charge a huge margin initially, and you try not to lose it over the 5 years that the product takes. So that's definitely one thing that people expect. But it's also difficult to attain because there's a lot of existing infrastructure. There is a lot of work that has to go into before you can actually reap those efficiencies, those claimed efficiencies, right? So the other aspect I think that's important to consider is that you don't want to somehow issue or tokenize the product into some kind of silo, so where it sits and pretty much investors can buy and hold it, but have nothing to do. So I think the application ecosystem that you're issuing into is critical so that your asset gets actually more utility than the traditional counterpart, that you can leverage the efficiency of settlement to move it around faster, to make it more mobile and use it in more different contexts than what you can do with the traditional asset. So I think that's sort of some of the things that we see our customers on the lookout and that are important when considering which environment.
Rob, did you have something?
I'd like to just anchor on something you said, and that's bringing more utility to an asset. So when we get to tokenizing anything, real-world assets, products, or even tokenizing other digital assets in space, you have to pause and ask, when you've changed that, have you changed the nature of which the asset represents, right? We ask the silly question, what's the thing? Right? If you fractionalize a building, what have you done? Have you created a digital representation of the building in many parts? How does that default? And so to really answer that question, you think about what the token represents, what it's doing technologically, how that matches with how it's described in legalese, and then how do those things compare? If the utility that the technology allows doesn't truly comport with how it's described legally, we have a problem. And so it's important for all of us in this space to really understand what is happening with that asset. Because in the instance of a building, if you just tokenize a building and you disperse the rights amongst a bunch of humans and enterprises, you may have created a partnership, which is probably not what we've expected, right? Or if you've taken we've seen some already start to tokenize securities, traditional stock, and tokenizing it. But if that stock has different utility than a traditional share of stock, which is just issued normally, because it does different things when tokenized, you may have created a different asset, right? It may represent something other than stock, which from a tax and a legal standpoint has significant consequences. So we're always comparing what is happening technologically, what are the rights and obligations to the holder, as well as the issuer. I know not everybody likes the word issuer, but really compare and contrast. What have you done technically? How does it compare legally? And then let's circle the wagons and make sure we've checked all of the different stakeholders that are relevant before we answer the question, what's the thing?
And Georg, you brought up, having worked for a large financial institution, you've got these traditional systems. Now you're adding, both the public and private potentially. How important is this interoperability question? I mean, to me, it sounds extremely daunting. So I'd love to hear you guys comment on that.
So interoperability is sort of how shall I say, the effort of blockchain, right? Everybody sort of says it, but really what I've been observing is that people mean very different things when it comes to interoperability, right? To me, it should describe this core capability of two applications seamlessly transacting across each other, right? Because that's really the part where we do things fundamentally different to how things work today, right? To me, it does not mean, bridging two different ecosystems via some sort of message-based mechanism, because then we're just recreating the old world, maybe with bigger silos, but there's still, you're breaking the transactionality across, right? So interoperability to me means really being able to take an asset into the context of different applications seamlessly. And that's what sort of creates, I would say, the added value of having tokenized that asset in the first place. So maybe going back to your earlier question about the use cases, what we're seeing is definitely the focus is on tokenization in general, because that's the foundation for a lot of the other sort of secondary use cases, if you will. But then once our customers have tokenized the asset, the conversation goes very quickly into, so which application can we connect to? Is there a lending market that we can connect into? Is there a financing market, or just a secondary trading platform that we can connect into? And really, again, when the applications seamlessly interoperate, that's where we can cut out a lot of the reconciliation and really reap that efficiency and that velocity of the asset that tokenization promises.
I think I can add a few things. Also, in the previous question, you mentioned about, at a new technology come in, I would say Gen AI is in that state right now. Every board wants to see a paper. They want to create a team. We engage with all the top consultants and all the top companies. I mean, we work with Microsoft, so OpenAI is a regular, company coming back and forth the UBS doors. But when it comes to blockchain, I've now realized it's about real return of investments. It's not about a good project you're participating in or being nice to BIS and being part of their experiments. It has gone beyond that point of experimentation, and organizations now really want the return of investment. So I would agree with Georg saying, it has to have some tangible value coming out of it. Otherwise, there is no appetite for projects like these. Second of all, I think coming into, the interoperability challenge, it is interoperability at two sides. One is interoperability with our old financial systems, because if it doesn't connect, we do not want to give our traders two interfaces to work with, two compliances to work with, two legals to work with, and two set of clients to agree to. It has to connect to that interface. So it's interoperability with the old financial systems to the new financial systems, which I think is a problem not fully solved yet, because we continue to keep doing things over and over again. I particularly feel the financial industry can come much closer together to solve that problem once for all. The second thing around interoperability, which everybody talks about, is interoperability of different chains, whether public chains or private chains or just data stores with the chains, off-chain and on-chain. And that's where I want to applaud the work that GBBC has been doing on creating a taxonomy first. It's about technology and bringing the bridges together, which is a little more secondary than us speaking the same language. What are we calling funds? What are we calling instruments? Is it a layered solution? Is it a flat solution? Because the terminology in the space of finance is different from one another. So if the products do not talk to each other and we do not call the same thing, elephant, and apple, that would be a bigger restriction on interoperability and seamless work than the bridges. I mean, we all know Wormhole has been trying to do stuff and got hacked in 2022 because the bridges don't work. There are lots and lots of other projects that are coming together. I think Canton Network is a really good example of trying to bridge that ecosystem. But before we kind of try bringing our very isolated islands together of blockchains with its private and public, it's important that we agree on a terminology and start working on solving some of the marketplace challenges together. And the bridges are the primemost attack area when it comes to cyber. And I don't think seeing that quantum is going to be here in 2025, that it would be a bigger problem to solve than even today.
Yeah, we all have this vision now of interoperability, right? Where you can exchange, commodities for securities for futures on cheeseburgers, right? Whatever it is, and that sounds good. But then, to your point, when you're transitioning between protocols, have you done something different, right? Is there different utility? What about the consensus mechanisms? Do you truly have different rights? Similar to my last comment. And we have to watch this interoperability comment. It works great from a technological sense, right? It enables all kinds of free trade, and the market's going to open up, and it's just fantastic for efficiencies and all of which Georg mentioned. But we need to pause and ask, does it work? Just because we call it the same thing, is it really the same thing? And do you have an inherent transaction in the middle when you've transitioned between enabling technology? So it's one thing what you call it, but you really got to stay close to the tech.
So, we've got some legal consistency standards and taxonomy to worry about. So, how do you see the future kind of unfolding, public versus private chains? Isn't it that institutions need both, right? And they need it interoperably.
Yeah, I see there's definitely space for both sides of the equation, and it really depends on the use case at hand, right? There's use cases that can actually be supported on entirely permissioned, entirely public chains. So I'm fairly certain that these environments will stay. On the other hand, as we've mentioned before, you have a lot of sort of bringing your traditional financial industry on chain requires certain level of control and some guardrails to be able to do that. So I'm also quite certain that kind of the other side will remain there. What I think is going to happen is that I don't think there is sort of such diverse requirements that will end up with having hundreds of ecosystems that are flourishing, right? So I feel like there's a handful maybe of ecosystems that are fundamentally different and that serve different kind of use cases and target audiences, but ultimately it's going to be a handful. And then when it comes to really interoperating between those, I think that's the point where we can start thinking about if there's real economic activity in one and another application that has activity on the other, and there's a really good business case to connect these two, then you can figure out what should the solution should be. And maybe at that point we arrived at having truly safe technical bridges. Maybe we rather bridge through a trusted intermediary, a custodial bridge, or even at the issuer level. So I think those solutions will emerge as we get to the point where we see there is a real business case to do so.
Does that happen through consortiums or GBBC, or how do we progress, I guess, is the question.
One interesting example is Canton, right? Where we're starting off with a trusted group of a few, maybe 10, right? Where these parties know one another and they're trusted, and they're all very focused on making sure that the initial use cases work and there's a level of compliance based on the known use cases in the regulatory environment now. As that network evolves, presumably they'll be pretty selective about letting new people in. But what's nice about that is that they're already sort of guardians or gatekeepers about that which they're trying to protect, making sure that as the regulatory environment evolves, as new use cases evolve, they're making sure that the new participants they're letting in, they can trust to make sure that it's future-proof. That's an interesting way to start because it's very difficult to imagine where the world is going. We've all got these grand ideas. But the line between now and 10 years out is a little fuzzy. We all make these big predictions, but the path to get there, and particularly the regulatory evolution around the world and how that works out, there's a lot more lessons to be learned, right? We've learned a lot of lessons in the little failures that have existed, and certain regulatory environments around the world have reacted differently, and they've built some great stuff to try and combat that. Not everybody's on the same page. There's still a lot of lessons to be learned. And on that journey, as the protocols evolve, if there's a discrete number of parties who control and can very carefully let others in, then maybe it's an evolution between the private permissioned into something that feels a little more public, but you've gone there naturally versus this big bang out and anybody can join.
I think I would just lay it down to one sentence. If there is a business value, we'll figure it out.
Love it.
Because without a business value, just for the sake of implementing a technology, that time has passed, at least for blockchain. I mean, I'm saying it on behalf of Swiss banking, which is anyway very behind from the rest of the world, right, in terms of innovation. So that's a big statement. But just trying to use the rule of thumb, right? When you're talking about operational efficiency and you want to create a certain set of pipelines from one cost center to another cost center, from one legal entity to another legal entity of big corporates and organizations, private blockchain does its job really well because you're very efficient, your transactions are really good, there's no cost literally, and you just create those rails that are not the one that can very easily replace the traditional rails and do their job really well. When it comes to the open market and big organizations have to work with their vendors and suppliers and clients and everybody around and third-party investments, then you really need to be coming up with a solution which is publicly viable. And I think it's high time that we find that solution. Otherwise, there is a big set of friction and resistance in the organizations to step away from the current rails and move on to the new ones. Because not very many of us want to be the first one out there. Well,
I just want to hit on the point that you made around, when there is a business case, there's a way, which I really think is true, and it's also what we observed, right? We've been, over the past couple of years, there was this time where everybody was doing experiments, everybody was doing POCs, and that's not the case anymore, right? So there needs to be a business case, which is also a sign that I think as an industry, sort of we've matured, right? And we've gotten past that point of experimentation, and people do start to see real value. And just as a side note, sort of, I expect the exact same will happen with AI, right? We've seen
Absolutely.
this huge sort of verge of activity, and everybody's kind of fascinated by what these chatbots can do. But we're at the chatbot level right now, and it's fun to play around. But eventually, people will.
You should come listen to many of us on Wednesday.
Yeah, and eventually people will ask, look, so where do we get the concrete value? Case in point, it took me, let's say, a couple of weeks to really find out, how do I actually get the productivity gain out of that chatbot. So I think we'll see a similar evolution in that industry, maybe a bit quicker, just watching how quick this has become the topic of the day. But yeah, I think overall it's a good sign that our industry has reached that point, because the conversations are very different to 2 or 3 years ago.
So I might put this question to Georg and Rob more so, coming from a traditional financial institution, Tanvi. But how are you seeing traditional financial institutions? Are they adopting this slowly? What are you seeing in the market with the traditional FI going on digital assets, or looking at this question?
So from my observation, it's definitely accelerating. So all the larger financial institutions are using the technology in some shape or form. We work with the likes of Goldman, HSBC, BNP, hopefully UBS soon. So really, it's being adopted everywhere, and therefore, yeah, I think we're not quite at the point where it's slowly then suddenly. But we're definitely seeing an acceleration, and in particular, the people that we talk to are now the business people that are again asking for sort of what do I get out of it, and you have to be able to answer that. And I think we are at the point where we can answer that confidently. And therefore, I think this in the next year will definitely be defining for the industry, and we'll see a lot more uptake and a lot more headlines around actual proof points that people can really relate to.
Yeah, I mean, we serve most, if not all, the large financial institutions around the world. And from our perspective, there's none examples I can think of where they're not engaged in some capacity. They probably all have a different, what I'll call it, a readiness agenda. How are they getting ready? Or where are they experimenting? There's some jurisdictions around the world, this being one of them, where there's maybe a little bit of a safer framework for them to enter and experiment and test products. Not every jurisdiction is like that. But if you assume that this is truly transformative to their business model, and if they're not riding this and on the journey, then they will be disrupted. Then you got to engage in some capacity. That may be reinventing products, it may be replatforming, but you got to start somewhere. Starting from zero is going to be really, really painful. So I would say a different readiness agenda, some sort of experimentation somewhere in the world to get ready. And what you'll find is even those execs which are like, no, this is bad, we're never going to do this again, there's somebody in the organization who's pretty focused on this stuff, and they're probably credentialized by that same leadership team to go and figure it out. They're just being very, very careful about public-facing statements given the regulatory framework. But to answer your question, everyone.
Okay, so, but it really needs partnerships, right? I guess that's really central to the whole idea of moving forward for TradFi, right? They have to partner.
Either with one another or with the early adopter. Maybe it's a new technology, maybe it's a consortium, but it's teaming up somewhere in the system. It may be a different infrastructure, right? It may be a different provider. I mean, the where you start is saying not just what are we going to do, but what is our role in that new transaction flow? Like, where do we want to enter this space, right? And you shouldn't assume that the role they've had in traditional transaction flows is the same that they will have in the future with digital assets. So what is our role? Then who do we need to collaborate with to execute on those transaction flows, and then start from there?
So the next question, I'm opening up with this big word of tokenization, or the word that I'd love someone to define totally for me. But what does tokenization of real-world assets bring to public and private discussions? What does that add? Where's the value, I guess, of tokenization for private and public chains?
I certainly have a view on it. My team works on the tokenization engine for Damel and Canton. I mentioned earlier that we've seen, a lot of people kind of proving out the ground and like putting a token out there, but oftentimes that's where it stops, kind of. And to me, that's actually just a starting point, right? So if you put a position out there on whatever ledger that be, that doesn't buy you much just yet. So really, what it's about is bringing all that operational complexity, and structured products is just a very good example because they're inherently complex to manage, complex operationally and costly. It's really about bringing that whole life cycle on chain, and that will allow you to really gain unparalleled levels of automation, allows you to do straight-through processing, and then as we get digital cash representations on the ledger, also allows you to settle fully automatically across intermediaries atomically. So that's where I think the real value actually comes out, and I think we're still not a long way, but away from that. But we'll eventually get there, and I think that's where people will realize that what a game changer that actually is.
Just to add to what Georg said, I think custody becomes a very important topic in the life cycle of tokenization, right? We all know you have to create a token, you got to use a ledger, there are smart contracts, there is a need for liquidity, there's a need for the issuance of that token. But the stuff that most people do forget in the technology space, not in the business space, is the custody. So the clients need a solid custody that they can trust with. That's where most of the prominent player in the banking industry and financial systems are trying to play a game, because the most important thing for custody is not the technology, it's the trust of the clients that trust you with the other assets, that they can trust you with the digital asset too.
You brought up a great point when we were at our prep call, and you said that it gives you access to customers as well. Can you talk just a little bit about what does that bring to UBS?
As I said, that we're one of the biggest private bankers in the world, so we do have access to a very niche set of clientele that have a trust in the bank. So the currency that the bank has is the trust, not just the portfolios and the assets of these clients. So when it comes to tokenization, and especially in the structured product areas, we want to open up where everybody can do an issuance. Some of the boutique hedge fund can come up with very exotic structured products that can be made available to our clients. Because they trust us, and if you go through the right vetting process of the different issuers, and there is a proper understanding of the accountability of those assets, then just being a custodian of these assets is already a big store for banks like us.
Thank you. Rob, sorry.
It's funny, trust is a big deal, and some would say trust is non-fungible. There's a T-shirt or a button somewhere in my backpack for that. But it's true, and it anchors on trust, and I couldn't agree more with the topic of custody. We need to really think through what this concept means in the new world. But one of the things that's not been mentioned in tokenization that I find impactful is it's not just the products that we're reinventing, it's the new fund flows using programmable funds in the execution and the settlement of these products, right? The future of money is something we're just starting to get our head around. And whether it's traditional crypto or whether it is stable coins or whether it's CBDCs in some capacity, all of these have an ability to interact with the smart contracts that you mentioned and these products with so much greater efficiency and transparency. This is outstanding for the economic circumstance in all of our communities. That is what I find most exciting about tokenization. It's the new funds flow of the future of money.
So we're going to open up just for a couple quick questions, and I'm going to do a quick summary so that I make sure I got everything that all these folks said. Sure. Go ahead.
Hi, my name is Konstantin. I'm a private investor. The question is future. So when do you see me being able to buy, just like a Bitcoin, a piece of UBS or a piece of Saudi Aramco, anywhere in the world? Maybe a question to all of you, like 95% confidence, like from 5 to 7 years, 10 to 20 years, and maybe one of you to qualify the answer.
I think I can start giving it a try. You can already buy a part of UBS. The shares are running in the market, and the shares are really doing well right now. With a lot more liquidity than Bitcoin. One can say with confidence. But I think what you're trying to say is if there is a possibility of tokenizing these shares, just like the way we have tokenized, that we have an asset like Bitcoin and other coins out there. Not for the big banks or the big organizations that are publicly listed, because you don't have a need for it. You can own a part of those big organizations by buying in their shares. But for the smaller organizations, private organizations that have not gone through an IPO, that are not in the market, that's where Switzerland has done an amazing job in terms of the regime, the very comfortable regulatory regime we have. So there are companies like Dara, Actionrat here that are tokenizing these shares for these companies available for individuals. Because that was a market that was just in the hands of private equity before. So that gives these newer companies, smaller companies, a lot more capital to work with. And for private investors like yourself, you have a bigger market. Not just the bigger market, but retailers like us also have a share of that market.
Yeah, I would just add on to that. Fully agree. It's exactly because public equity markets are already extremely efficient. Therefore, I put them sort of down the list when it comes to leveraging that technology. It's just that I think there's a lot of other assets out there that will come first because there's much more obvious benefit and value to be had.
And I think our time is up. We have 2 minutes. Okay, one more question. Let's.
No, go ahead. No, please.
2 questions.
Thank you. My name is Hung. I'm the head of Quantum Finance of Swiss FinTech Association. So I just have a question for everyone. What would be the evolution of Bitcoin, digital assets, in the rise of quantum computing? How can we leverage upon AI, machine learning, and now ahead to quantum computing? Thanks.
I know there's some. We're going to address some of this later in the week.
I can go on for an hour.
Okay. Yeah, I know.
See, both sides help both sides. So when it comes for AI helping blockchain, I think the biggest thing is just creation of ledgers and smart contracts and the use of Copilot for software. Just the way any other software is using Copilot. I mean, I have started to see our smart contracts have started to become a lot more production ready than they used to be because people have started to use Copilot. That's the first place AI is already helping. Bugs and test cases for blockchain. Those are the hard work that humans were doing individually. And now AI can help them do that. It's not perfect. It has still got hallucinations. It gives you certain cases where the bugs are not bugs and they haven't found a bug, but it's so much more better than not having it. The third area where I also feel it is going to bring in a lot of efficiency is how are we going to be trading and how do we understand the volatility of the crypto market. And that again is a very hard task to do because the market moves up and down. See what happened last week with the ETF being approved in the Americas for Bitcoin, and look at the markets today. It's extremely volatile. And that's an area that AI can also help with in terms of anticipating what the markets is going to look like, because it can incorporate thousands of factors that goes in deciding the market. And obviously oracles. That's a big challenge for most of our blockchain projects. That's where AI can be super, super helpful in getting our oracles so much in place and so much more accurate than they are today.
So we've got to close up here. So thank you, everybody. A couple words I took away, connectivity, control, public-private, tokenization of sort of all assets. We need regulatory and compliance. I really resonate with your response about regulatory and compliance. 80% of the work for large institutions. TradFi is accelerating into digital assets. You need a real ROI. And, I think custody and trust, big words that, so that's what I took away. Thank you. Great panel. Learned a lot and appreciate it. Thank you, everyone.
Thank you, Lynn.